Hey team, have you ever wanted to trade credit spreads and make monthly income in a way where you avoid market crashes, where you can understand the trend and profit from it, and in a way where you know the mechanical rules so that you know if this happens, this happens. If this happens, this happens. If the market crashes, this is how I handle it. If the market goes up, this is how I handle it. This is where my take profit is. This is where my stop loss is. I'm going to cover all that and more in this credit spreads masterclass. Now again, this is an extension of a credit spreads masterclass that I made at the beginning of 2023 and that literally thousands of y'all have already gone through and loved, and I've seen the profit reports from it. But I wanted to come in, update it, and do a better job at explaining how to navigate certain markets that have presented themselves in 2023, like low volatile markets, like range bound markets, and how you can profit from it. So I'm going to be covering credit spreads and all that in this video. So let me dive into it right now. Number one, what in the world are credit spreads? Credit spreads are the idea that you make money by betting on the direction of a stock. So if we look at this, let's just say, again, I'm not going to get into the specifics of the strategy just yet. I'm just explaining credit spreads. Let's say you're like, wow, look, this market is rolling over. I think it's going to head down further. If you think it's going to head down, for instance, like this, like move lower, let's see if I can bring up a drawing tool. If it's going to head lower like that, then you can take advantage of a call credit spread, which is a bet that the stock will stay below a certain level. So you pick a level, let's say this level. As long as the stock stays below it, you make money. That means that, let's say the market goes up and then stays below it, you make money. If the market goes sideways, you make money. If the market drops like you're thinking, you make money too. So in all these scenarios, you make money. Now vice versa to the upside. You pick, let's say you trade a put credit spread. That means that you think the stock will go higher. You're betting that the stock will stay above a certain level. So let's say you put this level here, you think the stock will continue going higher, and so if it does, it stays above this level, you make money. That means if it goes down, it stays above your level, you make money. If it goes sideways, you make money. If it goes up like you're thinking, you make money. So again, put credit spread, you're making money to the upside. Call credit spread, you make money to the downside. You do this all by picking a level you think the stock will not pass. So that's my very basic explanation of credit spreads. Now, something you do need to know about credit spreads is broker requirements. So again, depending on the broker you are using, there are some things you need to understand. Number one, you need to have a margin account. So that is number one, a margin account, which typically for most US brokers requires $2,000 minimum deposit. So if you have $2,000 in your account, you can typically apply for margin. When you do apply for margin, there is a questionnaire you have to go through. Make sure you say the right things. I'm not going to say lie, but you do need to put on those lists, especially if you have near that limit around 2,000. If you have more, they give you a bit more wiggle room. But if you're at 2,000, then you need to say, yes, I have experience with options and all the other things that come with it. So once you do that, you'll get approved for margin, and then from there you can start trading credit spreads. Depending on the broker you're with, you need the highest level of margin because you are selling an option when we put on these credit spreads. Again, I'll explain that a bit more in a second, but I just want to go through the bare bones basics, the foundation here, which is setting up a broker account with it. So once you do that, then you have credit spreads access. My favorite brokers to use are Robinhood and Webull if you have a small account because they do not charge commissions. Your fills, aka how fast your trade gets executed, will be slower, so it'll be harder to enter and exit trades, but you don't pay commissions outside of a few cents. That's regulatory fees. Now, my favorite is Tastytrade because they cap your commissions. So when you start getting to a larger and larger account, you can move over to Tastytrade, and then again, their commissions are a bit higher, but you don't pay to exit, and they cap them. So those are the broker requirements that I like. Number three, okay, the next step, because we talked about the basics, now we talked about broker. Number three, we're going to get into the specific strategies and how we set up these trades. So again, when we're looking at the market, there's a specific thing we look at. We want to take advantage of the current short-term trend. And so if we see this blue line here, this means we're having a short-term long trend that's supported by the long-term trend. If you see a white line, that means we have a short-term downtrend supported by the long-term trend as well. If you see a gray area, that is where our trends are conflicting. Our long-term trend, our short-term trend are different. And so if that's the case, we stay out. So blue, we buy, white, we sell, and gray, we stay out. So how does this translate into credit spread world? It translates blue, we're going to be entering put credit spreads. White, we're going to be entering call credit spreads. Gray, we're going to be staying out of the market. or putting on a trades at our own discretion, aka whichever way we want to put it on, but doing so at half our normal trading size. Now, that is what we're looking at with this indicator, which again, you'll get free access to at the end of this video. I'll show you how, but let's walk through the absolute specifics of this so you can see, hey, checklist style, how this works. So here's our criteria laid out in a PDF document, which is down in the bottom description of this video. But we're going to go to the bullish play. This is where we're starting, aka when this line is blue, what are we going to do? Again, that rhymes and I'm not a poet. So let's look in. Criteria, the stock price needs to be greater than the 200-day moving average. What does this mean? It means that if we pull up a moving average line on this chart, the 200 period moving average is greater. It is greater than that. So if I go here to moving average and I pull up a simple moving average simple, and I make that to a 200 period like this, 200, then it needs to be above it. You can see here, we are above this line. So that's what we're looking at. Number one, greater than the 200-day moving average. Number two, stock price is less than 3 standard deviations of the 200-day moving average. Again, if we go here into this line, it's going to show us that. If I click here, enable proprietary trending band. Again, this is on the indicator. I'm going to show you how to get access to it at the end of this video. Again, you can see here that it's below this top line. Why do we care if it's below this top line? Well, because every time we break above it, it tends to start retracing. You can see here, especially the most notable strong case is when we held above it for a while in 2020, and then it crashed. And almost every single crash since, when it breaks above this region, it tends to crash hard. So if the stock is above this region, it's hit its resistance. So there's no point in us trying to get in that trade. So that is what we're looking at there. Next, SMA 10 is greater than yesterday's SMA 10 price. So again, I'm just going to convert this SMA I just added into a 10 period moving average. So again, I just make it a 10 period. And so again, you can't really see it because it's being overlapped by the one that I have here. So let me remove the white, blue, gray line. All right, so you can see here, we have the 10 period moving average. When the line is moving up, when this 10 period moving average is pointing to the upside, aka it's getting increasing amounts of value. If it's trending up, that means we have our buy. So if we're above the 200-day moving average, we're below this level, and the 10 period is trending up, that is our short-term uptrend. Next, we need to make sure, this is a small caveat that we have on the trade, that when you do this, it just increases your win rate, but you don't want to enter when the stock has crashed massively. It is great to enter on red days, but when it's starting to crash massively, you kind of want to stay away from it. So you want to make sure that the stock price is greater than 15. Why is that the case? Well, because if we're trading the trend up and it starts to massively drop, should we enter that? No, we want to wait till we start to see the dip form, or we start to see a move back up. We're trading the trend. We're not buying on a low point and hoping and guessing it's going to rise against us. We're trading the trend. So those are our criteria right there to set up this trade. Again, that's all shown to you automatically when you have this indicator enabled right here. When you say enable blue, white lines, when you see this here, it's enabled for you already. So again, but these are the specific criteria if you want to know them for yourself. Next, how do we set up the credit spread trade? Well, a credit spread trade is set up by selling one option and buying another. So let's walk through this as an example. So let's say we're going long on this. Let's say we're looking to trade long because it's breaking above resistance or something like that. Then what we're going to do is we're going to pick our level and we're going to sell a put option. So we're going to sell a put option here. So that means we collect money. When you sell an option, you collect money. Why? Well, because anytime you sell anything in the world, somebody has to give you money for that. So if you sell a bike, someone's paying you money for that bike. So we're giving someone an options contract and they're giving us money. So now we collect money. Let's say we collect, ooh, that's a terrible plus sign. Let's say we collect $100. Cool. Now, we're going to have protection, right? Because credit spreads have a stop loss built into them. So we're going to buy another put right below it. When we do that, now we pay money for that contract, which is our protection. And let's say we pay $50. So we get $100 from the first contract we sell, and then we give up $50 to get that protective option. So that means our net difference is going to be $50. So that means if this trade goes well and stays above my level, I will make $50. That's why the spread comes in. It's the credit between the two options prices. That spread is what I make. So that's $50 in this example. So that's kind of how we see what the credit spread is. It's two different options set up to put on that order. Now, when we're setting up an option, we have to look at multiple different things. They have strike prices, they have expiration dates, they have deltas, they have different things like that. So when we're entering in this trade, this is what we're looking for. We're looking at the current date, then we go out 9 days around to the next Monday, Wednesday, or Friday. So we're looking to trade the Monday, Wednesday, Friday expiration dates 9 days out. So when you go into the options chain and you see how far out each contract or each expiration period is, it says 1 day left, 2 days left, 5 days left. Look for one that is closest to 9 days, and that's going to be the one that you trade. Next, you want to target a 30 delta. This shows you how far away from the stock price you are. So 30 delta is your key level to enter in at. Why? Well, because 30 delta gives us a nice buffer, but also allows us to collect enough money for when we want to offset losses, which I'll be explaining here in a second. Next, you want to create a $1 wide strike put credit spread based on the 30 delta short put. So what does this mean? It means that, let's say we're going out to this level, we do the 30 delta, and this level is 445, for example. That means that I'm going to sell the 445, and I'm going to go $1 below it. So I'm going to buy the 444. So that's how I'm going to set up my credit spread trade on my broker. Again, in this course series, I'm going to put down below links to show you how to actually execute these credit spread trades, but I really just want to teach you these strategies in this video. All right, so let's remove this. Let's go into the bear play strategy. Again, that's when this line turns white. So if I come here, again, I'm going to kind of come down. We can see the short play strategy here. So number one, we look for the SMA 10 price is less than yesterday's SMA 10 price. What does this mean? It means that the 10 period moving average is moving lower. It's moving down. When it's moving up, we're trending up. When it's moving down, we're trending down. So that's the first criteria we look for. Number two, we want the stock price to be less than the SMA 10. So not only do we want this line to be curving down, but we want the stock to be below this line, showing that momentum and strength is to the downside. Next, the stock price is greater than -3 standard deviations of the 200-day moving average. So this bottom line, it's the same reason for the upside when we stayed out of it when it was above this line, because this shows our support level. So let me get rid of the drawing. So that means that if the stock starts to break below it, there's a good chance that it bounces. So you can see here that it went below and then it bounced, it went below and then it bounced. And so if we're trading a call credit spread, we want the stock to drop. So if there's a good chance that it bounces here, that's not a level we want to be in. So again, we want the 10 period moving average to be curving down. We want the stock to be below it, but we want the stock to be above this level because that is our mathematical support. Number one, we want the stock price to be no more than 1%, no less than 1%. So again, what we mean by that is no more than 1, no less than -1. So we're looking at that range, aka the daily moving range. That just increases our win rate. It's something I've noticed through thorough back testing. So again, it just means no significant moves. Why? Because significant moves mean that the trend could be changing or something like that, and we want to jump on a trend that's moving well. We don't want to jump on a trend that's potentially changing against us. Next, the stock price is not less than 1 standard deviation of the 200-day moving average, nor greater than the 200-day moving average. So this can complicate some people, so let me show you this visually. When we are within a certain level, being the 200-day moving average, which is this gray line, and the 1 standard deviation, which is this light, faint gray line, if you can see that, when we're in this range right here, we do not want to be short. Just historically speaking, when we look at the data, if we get short in this period, we have a very low win rate. So when we stay out during this period, we not only increase our win rate from 72% win rate to 76% win rate, but we make more money in the long run. So why is this the case? Well, because when we get inside this range, there's a very high likelihood that the market will find support and bounce. And again, what are we looking for? We're not looking for the market to go against us. We're looking to trade the trend. So we do not want it to go against us. So since this has a high likelihood chance of going against us, we just stay out during that period. So that is something that we're doing as well. Next, how do we set up this trade? Well, it's the same way we set up a put credit spread, except to the upside. So let's say we're going short here. We're going to go out and we're going to put a level here where we think the stock will stay above. And then once the stock stays up, the stock will stay below. And then we go $1 above that, and that's how we structure our call credit spread trade. Just like that, we sell a call option, we collect money, we buy an option above it because it's further away from the stock, and we give up money, and that spread is our difference, and that's how we put on a call credit spread trade. The specifics of it, the same thing as before with our expiration date. We're looking for that 9 days out expiration date. Next, we're going a bit further out. 25 delta is further away from the stock price than a 30 delta is. So we're looking to go 25 delta out, and we're creating a $1 wide strike call credit spread based on the 25 delta short. So the 25 delta short, let's say, is 450. So we're going to sell the 450 call. Then we're going to go one above it, 451, and buy the 451. So again, that's exactly how this works, and that's how you can structure this trade to make money. So let's get into the specifics of sizing and more like that. Again, all that is explained here in this document, the exit rules and stuff and stuff like that. But I want to give you a visual explanation here. So let me remove all these drawings and get into it. So I think that's a drawing as well. Remove that. Okay, so if we're looking at this, how do we manage different things? Well, our number one rule that will save us from a lot of headache is position sizing. If we get position sizing right, we will survive in this game no matter if the market crashes or not. If we're making money or not, we will survive. If you get position sizing wrong with credit spreads, you will blow up your account faster than you'll ever realize. And so again, I've seen this happen to too many great traders, or too many traders in general, is that they size up way too much because they know that credit spreads have a high win rate, and so they want to take advantage of it. Then it goes against them and they lose almost all their money. So sizing is one of the most crucial things ever. So let's get into position sizing. So again, position sizing works based on your account. Let's say we have a $10,000 account, all right? What we need to determine is how much money are you willing to lose during a losing streak. When you're trading credit spreads, because of the high win rate, there tend to come losing streaks, not loser, winner, 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 loser, winner, winner, loser. It tends to be loser, 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 and then a huge streak of winners too. So we tend to get our losers and streaks. So when that happens, you need to understand for yourself, how much are you willing to lose during a losing streak? So let's say I have $10,000, which means, let's just say, for example, I'm okay losing, let's say, $2,000 on a losing streak. If I'm okay losing $2,000, then that actually shows me how much I can stand to lose for every single trade. So our average losing streak is roughly, when we have a super long losing streak, it's around 7. So if we have 7 losers in a row for our longest losing streak, and we are okay with losing $2,000, then we're going to take the $2,000 divided by the 7 trades in a row. So that shows us how much we can risk per trade. So if I bring this in here, it shows us 2,000 divided by 7 gives us $285. So let's round up. So $300 is the amount of risk I can take per trade. If $300 is the amount of risk I can take per trade in order to only lose this much money during my worst case scenario, which is 7 losers in a row, then I can only put on 3 trades. Why? Well, because for credit spreads, especially a $1 wide credit spread, it takes $100 of risk to put on a trade, or $100 of collateral to put on a trade. And because of that, divided by 100, that means that we can put on 3 spreads. So with a $10,000 account, with the risk size that I am okay with, I can only put on 3 spreads per trade. Now again, I can be in multiple trades. I can be up to 2 trades a week. I could be 2 trades one week, 2 trades another week, 2 trades another week. But again, as long as I have 3 spreads per trade, then my risk will be managed correctly. And so again, 3 spreads per trade is my risk management based on a $10,000 account, and me being okay with losing $2,000 during the worst case scenario. So again, you need to determine this and do this math for yourself to determine where you stand. Because again, if you do not get sizing right, you will blow up your account faster than blinking your eyes. So that is number 1. Number 2, how do we exit for a profit or exit for a stop loss? Well, quite simple. Again, when the trend starts trending, when the trend starts going in our favor, right? Like let's say we enter a put credit spread here, which makes money to the upside. This is our level. As long as the stock stays above this, we make money. Then the market goes up. The more the market goes up, the faster we make money, or the more money we make, right? Because it's moving away from our price, which means that we're more likely that the trade will go in our favor. So we make money, and so we make money, and we can exit early. So again, we're typically entering credit spreads around 20 to 25 cents, which means that when I enter a trade, I'm going to make 20 to 25 cents per spread. And so that is my max profit. But I'll say the trend starts going in my favor, I'm going to exit around 5 cents, which means that if it's trading at 5 cents or less, I want to get out of the trade. Why? Well, because I made most of my profit, I can get out and I don't have to worry about the risk, and instead can use that money I just made to put into the next trade and roll that into the next trade and then compound my profits. So again, if the trade's going in your favor, you can close it for 5 cents or less, do it. You still make a great profit and you're reducing risk from your trading size. So again, that's what we're looking to do. Enter around this level and exit around this level for our take profit level. For a stop loss level, what do? When we put on a credit spread, we are betting that the stock will stay above a certain level. In this instance, we're saying that it'll stay above this level. If the stock happens to go like this and then break this level, why would we hold on to the credit spread? Is there a chance that it comes back up in our favor and makes money? Yes, of course there's a chance. But there's also a chance it doesn't, and we end up losing a lot of money. So as soon as the stock breaks your level, exit out of the trade. Now, the way that credit spreads work, the price you get for the credit spread shows your likelihood chance of winning the trade. What do I mean by that? Well, if we're collecting a 20-cent spread, that means we have an 80% chance of the market not coming down to our level. If we get to this level and we're here at our level that we picked, what's the likelihood that it goes up versus goes down? Well, it's 50-50. There's an equal likelihood chance that the trade makes money or not because it's at that level. And so that means that the spread will be roughly priced at 50 cents. 50 cents is our mid-price level. Once we hit that strike price, it will be trading around 50 cents. And so that's how we manage it. So again, we enter in, we get about 20 to 25 cents. If it goes up, we exit at 5 cents or we hold till expiration. If it goes against us and hits our strike price, then we exit at 50 cents, which means that if we enter at 20, we stand to make $20. If we exit for a stop loss, that means we're closing at $50. So that means a net loss of $30 because we entered at 20. So that's a great trade right here. You make 20, you risk 30. That's a really good trade, especially when you manage risk. So that's how you manage risk correctly using this system. Now, one thing we do have to talk about is something that has been prevalent in 2023 and again can be prevalent in the future depending on how the market behaves, is what is called range-bound markets. So again, you can see here, if we zoom out, we have trending markets. This is an uptrending market. This is a downtrending market. This is an uptrending market. This is a downtrending market. This is an uptrending market. But sometimes we get put into weird phases like this where the market is range bound. When the market is range bound, how do we trade this? Why? Well, because look, let's say I enable the CSCT indicator. I want to see which way the market's trending. So I come over here and I enable this little white, gray, blue line. Again, when it's blue, I enter a put credit spread. When it's white, I enter a call credit spread. And so when I look at these levels, what I start to notice is that, let's say I'm getting short here, so I do a call credit spread, and then the trend reverses, and now my call credit spreads here end up losing money because it reverses against me. And so again, when we're in this range-bound market where it goes up, down, up, down, up, down, you could easily be in a lot of uptrend trades, and then it reverses against you when you have that losing streak. So how do you avoid that? Well, number one is by making sure you monitor these gray points of the line, these areas where we stay out of the market just because the risk is high. When we do that, we naturally increase our win rate. But what else can we do? When we start seeing the market push into resistance, what we should start doing is we should start taking off profits. If we have a profit on trade, take off profits, and we should enter in, if we do continue to enter in trades, enter in half size. So when are these periods? Number one, when we break into this top line, when we start hitting this top line, we should start taking profits. And if we do want to enter trades, enter very light size and enter both a put credit spread and a call credit spread. So we can make money on both sides if it starts to reverse against us. Next, another area. When we start getting inside these two faint gray lines, this means that we are in a lot of consolidation where we're going to go up and down and sideways a lot. So you can see here, rejection, bounce, rejection, broke above, and now it's trending up. But in this gray zone right here, we need to trade support and resistance levels. We need to trade the bounces here. Buy put credit spreads, or should I say sell put credit spreads when we get to these levels. Sell call when we hold this resistance. put credit spreads when we enter here. And again, during this period, because we're not following the trend, we want to do half size. So let's say if I normally trade 3 spreads per trade, then I'm only going to trade 1 or maybe 2, but I'm not going to go full size in case I have a loss. So as you can see here, during these gray periods, we just tend to go up and down. So we need to trade the low points and the high points for our credit spreads. And that can help us make money and avoid losing money during these volatile periods. Now next, what is another market environment where credit spreads tend to not do well? That is a low volatility market. Why? Well, when VIX, which is our volatility index, starts to come down, which is what we've been seeing since late October. So again, for the past month, VIX has just been shrinking. This means that it's harder to collect enough premium further away from the stock. What does VIX do? VIX allows us to go further away from the stock price and still collect a good amount of money, right? The further away we are from the stock, the higher our win rate is, because the less likely it is for the stock to drop that far, right? And so again, when we're able to move far away and still collect a good amount of money, that is great. But when VIX is low, we have to come up close to it and set our levels closer to the stock price. So that is going to mess with our win rate slightly. When VIX pops, we could have an issue. So something to understand is when volatility is low, start sizing down a bit. When volatility pops up, you can increase back up to your normal sizing and start sizing your positions based on the level of VIX and how far away from the stock you can go. So those are two very important markets, range-bound markets and low volatility markets, that you need to understand to help you increase your credit spread win rate. Now, congrats on watching this whole video. Again, you can join our program where we teach credit spreads, where we trade this exact setup, these rules, these systems in a program in our private Discord with weekly coaching and algo alerts that, based on this line, tell us when to get in and when to get out, and gives us these specific levels. So if you don't want to waste your time staring at a screen, it shows you exactly what to do. So if you want to join that program today with a free trial, which is again a very limited access, you can do so clicking the link down below, and that is just for you, for people who have watched this course. Because you watched this course all the way through and you've learned our system and you like it, and hopefully put on some trades to learn how it works, I want to give you a 50% off discount code that is only good until December 31st at midnight. So thank you for watching this video. Here is your chance to save 50% on our algo alerts, our coaching, and so much more. Again, you get access to our 10% credit spreads yearly program, which is normally $997, but you get 50% off today with the discount code I'm about to show you. You get the CSCT indicator for free, which I showed and we used in this video. Number two, you as a bonus, you get the IS2 lifetime access. So if you're a swing trader and you want to learn how to research stocks and have that done for you based on trending or trend following, you can do that with our IS2 lifetime account, which is another software that you get lifetime access to, which is a $5,000 value. You also get 48 weeks of coaching, so you can learn exactly how to put on credit spreads and how to trade them well. And so again, if you click on the link over there on the next page, again, you can go over here to this and go to your discount code, and on the discount code it is Christmas50. Christmas, because the Christmas discount, you get 50% off, and that changes your plan from $997 a year down to $498.51. So anyways, guys, I hope you enjoyed that and take advantage of this coupon code. Thank you so much for watching the video. Regardless of if you sign up, the information on this video, if applied, can actually make you a lot of money. And so my goal is for you to go and apply that, learn, see how it works, and when it starts working, then you want to join our program so we can work closer together and do so with a community of traders that are doing this just like you. So anyways, take advantage of this 50% offer before it's too late and expires on December 31st at midnight. All right, guys, see you later.